Are you prepared for the economic armageddon? That is in quotation marks on my script. And if not, do you need to be? An Australian economist is warning the recent turmoil on global markets is just a sign of things to come, and a massive crisis is on the cards. It's one opinion, but some on this side of the ditch share those fears, arguing a day of reckoning is indeed coming. Our economics correspondent Patrick O'Mara went to find out if such gloomy talk is overblown, and if it's not, how people can protect themselves.
To say that Australian economist and former political advisor John Adams is pessimistic about the prospects for the global economy is a bit of an understatement. He sees the massive sell-off of global stocks early this month, which saw American markets plunge 10% from recent highs, as the harbinger of an economic death spiral, eventually bringing about soaring interest rates, a collapse in share and house prices, higher unemployment and widespread bankruptcies. New Zealand Company Director Simon Botherway says while it's an apocalyptic warning, it shouldn't be dismissed out of hand.
I think that he points out a number of factors that suggest that we are in for some economic trouble, particularly debt levels.
John Adams uses a number of financial and economic indicators to test the vulnerability of the global economy, including indebtedness, savings levels and house prices. With global debt at a record high $233 trillion and interest rates on the rise, Mr Botherway says a day of reckoning is due.
Global debt at 325, 330% of global GDP is basically unprecedented, so we don't really know where that will end up, but there is economic precedent to suggest that those scenarios could be very bad.
But the managing director of the non-profit KiwiSaver manager Simplicity, Sam Stubbs, dismisses the doom-laden warning, saying we've heard it all before.
The people who are saying these things are the same people who are saying that the global financial crisis was the end of the world, and who fairly regularly predict that really bad times are just around the corner.
New Zealand is vulnerable on some counts. House prices are considered severely unaffordable in many regions. The average household owes more than 1.5 times what they earn, an all-time high. But Sam Stubbs says that cannot be looked at in isolation.
You have to look at people's ability to service that debt, and that is a function of how quickly is the economy growing, are wages going up, is there actually economic activity, which means people will be able to pay it off. The answer is actually yes. Globally, this is the first time in a very long time we've had all of the major economies actually growing. So there is greater activity, people are making more money, paying more taxes. That also means governments can afford more debt too.
Stock markets have already regained some of their composure since the recent plunges. However, with the prospect of higher interest rates dampening returns from stocks, Massey University's banking expert David Tripe says further volatility is expected and investors should beware.
The volatility is a response to a period of very low volatility, unusually low volatility, and we may be returning to more normal conditions. And under normal conditions, share prices go down as well as up.
While low interest rates globally have fostered a sharp rise in share and house prices, the head of research at Bank of New Zealand, Stephen Topless, is not yet convinced it'll end in disaster. And Mr Topless says New Zealand is in much better shape to cope than most countries, with a growing economy underpinned by robust construction activity, record tourism and rising dairy prices.
And additionally, if things did go really wrong, we've got a lot of fiscal flexibility because our government books are in pretty good order, and we've got a lot of central bank flexibility because we still have some of the highest interest rates on the planet, and we've never used quantitative easing. So I'm an optimist for New Zealand in a relative sense, notwithstanding that if things go nasty, we'll suffer in some way or another.
Financial columnist and author Mary Holm warns people to think twice about taking on more debt or risky investments. She says a prudent approach should be taken, even for those in long-term investment vehicles like KiwiSaver.
If that does make you worry a lot, then that's a signal to perhaps move to a lower risk KiwiSaver fund, knowing that it'll be less volatile, it'll probably also grow less over the years, but it's not worth losing sleep over it.
Mary Holm cautions that if people do move to a lower risk fund, they should stick with that decision and ride out any further turmoil. For Checkpoint, Patrick O'Mara.